Righty ho, let's crack into it. It's 2 o'clock. Hi everyone, and welcome to today's webinar about Know Your Numbers. I'm Alison, and I'm going to be your host for this webinar this afternoon. Just a couple of things of housekeeping. I believe the chat icon is in the top right-hand corner of your screen. I have got that open, and you can pop any questions you've got in there, and I'll be answering them at the end. There is a question and answer session at the end of this. This is also going to be recorded, and we're going to stick it up on our YouTube channel in a few weeks' time, so that you can come back and refresh your knowledge whenever you want to. And if you wanted to come today and you missed out, I'm sorry, but at least we could give this to you later in another format. So part of the reason why we're presenting this to you today is we want to share with you that not only does a picture paint 1,000 words, but so do your numbers. So our core values are around putting people first, and part of that is giving you guys education on how to make some better decisions for your business. So when you come in for your annual accounts meeting, you've got a grasp on the numbers so you can really sort of get into those burning questions, and we can sort of go through some of the lighter questions at the end. So to crack on, so today's agenda, that is me doing my best Dr. Evil impersonation, but over the next 60 minutes, we'll cover the importance of knowing your numbers, an overview on the different reports that you usually get to see and you should be producing, the difference between cash and profit, which is one we get asked quite a bit, the key drivers of business value, how to protect your assets, and how to adopt best practice. Then we'll go through some basic steps that you can take to make sure that you're truly understanding what your numbers are. So please take plenty of notes today. Some of what we talk about might sound like a foreign language, and that's Accountanese speak. So send through your questions again anytime, and we can answer them at the end. So let's get underway. The budget is not just a collection of numbers, but an expression of our values and aspirations. So this is just a little thought for today. So I don't know if anybody's got budgets for their business. It's possibly quite important to have one during COVID-19, but the numbers in your budget reflect your aspirations for your business over the next 12 months. So if you haven't already got one, it could be the time now to make one, make sure you understand you're monitoring your business over the next 12 months. And you can do that with a budget or a forecast. This webinar is about demystifying the common reports you see weekly, monthly, quarterly, annually, so that you know you're in control of your business's performance. So knowing your numbers is vital, as it allows you to interpret your reports and know if you're on track to achieve goals set in your business plan. Or you may have a business recovery plan if you're going through some COVID-19 impact. And here are our top 6 reasons why you need to know your numbers. They tell the story of your business. They allow you to interpret the results of your business activity. They help you identify the symptoms and the root causes of any problems. For example, a decline in gross profit is a symptom of many root causes like ineffective pricing, rework, wastage, and so on. Knowing your numbers helps you to spot early warning signs of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly increase and respond to that, and so that you can have control in changing those numbers. You'll also be able to see areas of strengths and weaknesses, and these will be highlighted. Your balance sheet, for example, indicates whether your business value is going up or down. And understanding your numbers also means you'll have reliable financial information to make your decisions on. And finally, my favorite line, knowledge is power. The more you know about your business, the better it will be. We'll be reviewing each of these 6 key reports to help you understand what you can learn from them. We'll work through an example of each one and show you what to look out for, because that's what we're looking out for too here, and we're going to use a fictitious company. So all the numbers are made up and the points aren't real. And if you're scared about 70 slides down the bottom, don't panic. We're going to get through them really quickly. So your trading account tracks your sales, variable costs, gross profit to calculate the return you're achieving before deducting fixed overhead costs. Your gross profit margin will indicate whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. So, for example, regional locations, you could have a tracking account in Xero for each location. Small adjustments in your trading account can have a big impact on your bottom line. And I'm going to walk you through that now. So this is my example company. This is a food manufacturing trading account. So as you can see, I've got the box up there. They had sales of just over $1 million and cost of sales of $318,000, giving them a gross surplus from trading of just $700,000. Their direct costs were $450,000. So their gross surplus was $248,749. Giving a gross profit percentage of 24%. So let's say they come to us for some coaching and we've worked through some strategies to increase customer retention rate, because it's easier to keep the customers you've got than to bring new ones on as well. Don't forget that. Let's say that they do this. So we increase their sales by 10%. We also work through any stock issues, inventory processes, and this reduces the cost of sales by 5%. You renegotiate a contract for delivery providers, getting an extra 5% savings in your direct costs. So as a result of these changes, here we go. Their gross surplus has increased by $140,251 just by making some minor changes, going from 24% to 35%. So understanding your trading account allows you to identify areas where small improvements, even just by a couple of percent, can have a big impact on the profitability of your business. So now on to the profit and loss. It's also known as an income statement. It shows all your earnings and costs throughout the year and tracks the overall performance of your business. It matches your income to your expenses for the period, with adjustments made for timing differences, like, for example, sales that haven't yet been banked, that you haven't received the money for. It's important to remember that the profit is not the same as cash. Profit is shown in your profit and loss statement includes non-cash expenses like depreciation. You must ensure you have sufficient profit to cover your cash costs, such as loan principal repayments, asset purchases, and drawings. Your profit and loss statement provides a framework to benchmark your results or comparisons against previous years and compare your business performance to, if you wanted to, other businesses in your industry. Businesses are generally valued using a multiplier of earnings, so your profit and loss is a fundamental driver of the value of your business. The higher your earnings, the higher your value goes. So this is an example of a profit and loss statement. I realize it's a little bit small of the same fictitious food manufacturing company. So we've got the gross surplus from the trading account, and now we've listed all the expenses, followed by the owner's remuneration to calculate the net surplus or loss. So here you can see the company is trading at a loss of $113,000. Let's say they go through and decide to do an overview and undertake a review of their overheads, and we identify some potential savings to be made with insurances. Say you get an insurance broker to review things and you renegotiate with your landlord to get a reduction in rent. So those little 5% reductions come across to you save $597 in insurance and just under $3,000 in rent. You'll notice so accountancy expenses have gone up. Remember on the previous slide, we talked about they brought us on to do some coaching and find some savings. So whilst that's gone up, despite that increase, the overall net surplus has increased by $138,000 to $24,000 due to the savings being made. So despite this, we've got $24,000 of savings, giving them now, they're in the profit of $138,000. So next, balance sheet. Your balance sheet is also known as a statement of financial position, and it provides a snapshot of your financial position at a specific point in time. It measures the net worth of your business, which is your business assets less your liabilities. It shows if your business is solvent. So if your liabilities are greater than your assets, then the business is insolvent and urgent action should be taken to fix this. You can compare different periods as to whether the business net worth is increasing or decreasing between years, and you can track the strength of your business. The stronger the balance sheet, the easier it is to survive a downturn. And that's one thing we've all learned out of COVID. It's also the basis to calculate some key ratios such as debtor days and inventory. If you've already been in and downloaded our free handout, there's some ratios in there that you can run through your balance sheet. So as you can see, I've got a balance sheet here. Again, my apologies, it's very small, but the company is insolvent. So as you can see, it's got net assets of negative $305,000. Its working capital is also negative, as the current assets are $138,475, and they're less than the current liabilities of $162,269. This means that the company cannot pay its short-term debt from limited cash, debtors, and stock. So urgent action is required to remedy this. The business needs an injection of funds of $305,000, and this could be in the form of share capital, capital raise, or a shareholder loan. Assuming the company can resolve these issues, we've got some other areas for improvement as well. So over the long term, you could implement strategies to reduce debtor days and inventory days to help increase your cash flow. So out to the left there, to calculate your debtor days, divide your debtors by sales, then multiply by 365. So this is how long it takes for customers to pay you. Currently, this company's debtors days are 26. This is on average 26 days to pay the bills. If you change your terms of trade and you request payment within 7 days and manage to reduce this by 5 days, so 5 days, so they're paying you now in 21 days, that 5 days difference will mean that you end up with an extra $13,944 available. And that's a big difference that 5 days in your terms of trade can make. So inventory days, similar situation. To calculate inventory days, divide your inventory by the cost of sales and then multiply by 365 days of the year. This tells you how long the business holds its inventory before selling it. In other words, this is how long your cash is tied up in stock. Currently, this company is holding its inventory for 74 days. If they reviewed and changed their processes, reduced the amount they had on hand, they could improve this by 9 days. That's an extra $7,860 in the bank. So while this is a cash flow gain across debtors and inventory of nearly $22,000, it doesn't quite solve the solvency issue we've got going on, but it does show you how much cash could be saved with a little bit of help. So now we're going to look at the statement of changes in equity. I'm just going to go through this one quite briefly. It shows what happens to your profits. They could be paid out as dividends or kept in the business's retained earnings. It represents the net worth or value of your company, and it's the indicator of key financial health. It shows whether you're solvent or not. Remember, if a company has more than liabilities than assets, it's insolvent, and funds need to be put into the company. So here we have a statement of changes in equity. So what this is telling us is that the company's actually accumulated losses for the last 3 years. It means that this company has no retained earnings and is currently insolvent. There's no money to pay out dividends, no money to reinvest into new assets. So this is a company that's in need of an intervention. So on to shareholder current accounts. So this is the one we get asked about a lot. Shareholder current accounts records all the funds that you put in and out as a business owner. If you're a sole trader, it will appear in your equity section. So it helps you monitor your personal expenditure from the business. And if you've got more than one shareholder, there's a couple of shareholders, so then you get an account per shareholder so that each one can see what they have put in or taken out of the business. It shows how much the business owes to each shareholder. If the account is overdrawn, it means you've taken out too much money than you've put in, and now you owe the company money. So to put the account back into positive, the shareholder can repay, or the company can increase its profit and pay out a shareholder's salary, or if it's in profits and it's got retained earnings, a dividend can be declared. So if your shareholder current account is overdrawn, it's important to get some advice from us as soon as possible so that we can work out the best solutions for managing that for you and your business. So here we've got my demonstration shareholder current account. So at the moment, at the start of the period, it shows that the company owed the sole shareholder, Mr. John Doe, over $29,000. He's put $2,000 into the company during the year, but he's taken out $9,000 in drawings and life insurance payments. So at the end of this, it means that John Doe owes the company the company now owes John Doe just under $22,000. The amount owed by the company to John Doe can only be repaid if the company is solvent and the cash is available to make the repayment. Because our example company is insolvent, John Doe unfortunately is going to have to put some money in so that it's not trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy is probably a good course of action to take. For example, as we demonstrated with the trading account and the profit and loss account, those small incremental changes can have a big improvement on profit and result in an improvement of $138,000. It's just not sustainable as a shareholder to keep putting money into the business if it's not profitable. So on to the fixed asset register. We also call this a depreciation schedule. It records a business's fixed assets, such as your vehicles, plant and equipment, buildings, land, all that sort of thing. And it all facilitates the spread of the cost of assets over their useful life. It provides a basis of keeping track of your assets and can be a useful guide to determine when assets need to be replaced, so you can budget for them accordingly. Other uses we've seen for it are for proving for insurance value. So it's also useful when selling a business that it records the current value of all your fixed assets. So a quick run through of this as well. The first column is your fixed assets. It lists all the names of your assets and all the cost values that they were purchased for. The next column shows the opening value of the asset at the start of financial year. This is the cost less the closing accumulated depreciation from the prior period. The next two columns show any purchases or disposals of assets. A disposal could mean that it's just reached the end of its useful life and we've just removed it from the register. Or it could be it was stolen, written off, sold, that kind of thing. Then we have the depreciation rate and the method used. So DV is short for diminishing value. You could have SL for straight line. It's just that there's a couple of different methods that are used for depreciating an asset. And then we have the next column, which shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. And then finally, we have the closing value column that shows the current value of the assets. This is what is recorded in the balance sheet. So it sums up the 6 key reports that you should be producing on a regular basis. Each report tells a different story about your business and aids your decision making in a different way. If you have any questions about any of the reports, you can keep sending them through and we can answer them in the meantime. I can see I've got a question through. Thank you. So actually I'll answer that one now. So the different methods for depreciation are diminishing value and straight line. So diminishing value is that it will depreciate by 30%, and so then your claims get smaller and smaller over time. It is probably the most common one. Straight line is, say, you'd write off 40%, 40%, 40%, and then the balance. So it would be written off sooner. It's sort of the more preferred one if you're writing off, say, computer equipment, which has a very short lifespan, that sort of thing. So it just comes down to sort of what sort of method and what sort of asset you're looking at as to which method you'd pick. So there are some flexibility there. Especially my personal favorite one is computers, because they have a very short life, so we'd like to write them off quite quickly. You don't want a computer on your asset register for 8 years, whereas you might have the motor vehicle and slowly depreciate it down over a longer period of time with a different method. So that's a great question. Thank you. So I'm getting through this a little bit quicker than I thought I would, but that's okay. So now we've gone through the reports, so we're going to have a little bit of a discussion now about the difference between profit and cash. So one of our favourite sayings is turnover is vanity, profit is sanity, cash flow is your reality. So it's common to get frustrated when you sit down and you see you've made so much money and you're sitting across from us and you say, but where is all my money? It's essential to understand the difference between profit and cash and why a high profit doesn't automatically mean you've got lots of money in the bank. A profitable business can go under because it's starved of cash. Again, this is one of the great lessons from COVID-19, is that cash is king. Though businesses that had cash have survived incredibly well. A business running at a loss can only survive if it has access to funds from investors, financiers, or shareholders that keep putting money in. In other words, cash flow is every business's reality. And that's why you're all part of here today as well, is knowing your numbers to get that cash flow. So to demonstrate the difference between profit and cash, I want you to consider these items. So for example, we've got GST. It affects your cash balance, but not your profit. Loan repayments, again, affects your cash balance, but not your profit. Interest on loans affects both your profit and your cash balance. Asset purchases affects your cash balance. Again, the same with asset sales. Depreciation is a non-cash expense, only affects your profit. So you can see that even if your business has achieved a really healthy profit, there may not be any cash in the bank after you've paid tax, you've made loan repayments, and you've reinvested in the business. So if you come to some of our coaching sessions, you may be familiar with this next one. And this is the Business 101 cycle. And this is one of the ones that I love talking to clients about. So the Business 101 cycle is a very useful way to demonstrate the difference between profit and cash. So here we go on my whiteboard. First, the owners need to invest some money in the business. So you put some money in, use it to purchase some assets. Assets are great. They generate income and they're needed to run the business. The business may need additional funding to buy the assets so that you can take out a loan to finance the purchase. These assets are then used to generate profit, what we like. Profit is just actually another name for return on your assets. So you can increase your profit by, as you've seen, growing sales, reducing margins, but also your drains, overhead expenses can result in a loss if you're not managing them correctly. So then profit gets turned into cash. Nice. Drains on your cash include slow collection of debtors. As we've seen, just an improvement of 5 days in our demonstration made quite a bit of difference. High inventory days, again, referring back to that balance sheet. Loan repayments, tax payments, payments to suppliers, that all going out will be a drain on your cash. But your gains, collecting those debtors faster, working on your inventory, or even if you're not carrying stock, say work in progress, negotiating longer payment terms with your suppliers and reducing your tax. The owners can then take cash out of the business as drawings or personal loan repayments. The remaining cash, we can then go back into the top of that wheel and it can be reinvested into the business to purchase more assets to generate more income. The aim of this is to go through this cycle as quickly as possible. The quicker you spin this wheel, the better the improvement on your cash balance will be. So after cash flow, business value is the next important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of business value. These drivers might be your monthly recurring revenue. They might be revenue per client or sales or profit. These will be different for every business, but with a coaching session, we can work through with you to identify what drives the value of your business. To enhance the value of your business, you've got to develop a plan. Remember, failing to plan is planning to fail, always. And you can implement a clear plan and document your structure and roles within the business. You can look at, and we're a huge one of it here at Xero, we're huge Xero fans. So cloud-based real-time reporting can get you better decision-making, better reviews of your systems, processes, and ensure that you're running as effectively as possible. And if you're interested in the sort of looking at your systems and finding efficiencies, we've got some things coming up in the next few months that will be of interest to you as well. Reducing the reliance on the owners of the business also can help enhance the value, as it'll be easier for new people to step in if you decide to sell. And finally, identifying and managing your risks, because these can be mitigated before they become an issue. So as we've seen throughout this webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have cash available, you don't get that financial freedom to pay yourself the lifestyle that you desire. And there are a few things you can do to help protect your assets, and I'll just quickly run through them now. So limitation of liability, setting it up in a way to limit your personal liability, consider who should be a director of your company and which assets are held personally by those directors as well. Ensure that you have security over any money that you lend to others. Consider alternative ownership structures. If you've got some high value assets, that's something we can work on. Say if you want to own your commercial premises that you're in, we can certainly work around that. Reviewing your terms of trade, again, just changing how quickly people pay you. Reviewing your credit policies, only giving credit to those that are going to pay you. When was the last time you reviewed your insurance? Make sure you have sufficient protection. Do you know if you have business interruption insurance, indemnity insurance? Do you have enough to cover any adverse effects that will impact your business? Ensure you undertake financial planning to manage your personal wealth outside the business as well, so that you get, and we'll talk about here the 3 freedoms, mind, money, and time. So how does everything I've talked about so far come together as best practice? Every business should have some essential tools. We count our essential tools as an annual business plans, or if you've been really impacted by COVID, you might have a business recovery plan. There are ongoing forecasts, reporting, and accountability. The reporting ensures the numbers that you want to achieve in your plan and forecast are being measured. And the accountability process is some form of coaching. So you could use us to hold you accountable for your work. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve the goals in your business. So where to from here in these times? My aim is to help you take what you've learned today and implement some positive change in your business. Now, it's time for you to decide what you're going to do. Take a few minutes after this webinar and write down 3 actions or projects that you think could add some value to your business. What problems are you experiencing in your business? Identify these problems and use this as an opportunity. Sorry, just hit my microphone right here in front of me. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Because doing nothing is not an option. It should never be an option. So here we go. We've got Tim and Joe on the screen. So now what you should be doing is best practice in your business. We can help you. If you don't currently have a business plan, we can help you develop one. We can also help create cash flow forecasts, which can reflect the ongoing impacts of COVID-19. And if you are one of the kind of people that need to be held accountable, we have a range of coaching options depending on the frequency that suits you. We can help you make some management reports so that you can track what you want to track in your business to see if you're on track. And we can also do a complimentary 1-hour meeting for clients as well if you want to look at some of these reports and get them done. On the screen, we have got a list there of some additional business development services we have. Just as per the small print, prices are applicable at the time of this webinar and are subject to change. We know it's difficult to commit to spending money right now. That's why all of these services will include an assessment of what you're doing to improve your profitability and cash flow. We can include some financial awareness training. So please don't let cost be a barrier. We're only too happy to help. There is a new one there called Cash Flow and Profit Improvement Coaching. It's a new program that we've only just launched this week. So if that sounds like something that you'd be interested in, definitely get in touch. Because I'm personally quite excited about it and would like to run through that and it's a 3-month program. So some clients that are already on this call know the benefit of coaching, and you know that the benefit is far greater than our fee. But most importantly, it's about helping you get to where you want to be to build a stronger, more resilient business. The information in this webinar is general in nature, so no substitute for specific tailored advice, but one-on-one, we'll be able to identify the most important actions to help you get the biggest impact on your results. So without further ado, my favorite slide, here is my email address. If you've got any questions, you can pop them through. Otherwise, if you'd like to pop them in the chat, I'm happy to answer any questions that there are, hopefully. So does anybody that's on this call, anybody using any KPIs to track things in their businesses? Is anybody using debtor days? While we sort of wait for some questions to come through. One of my personal favorites is if you've got somebody that works in accounts payable or receivable, accounts receivable is a good one. You can use debtor days as a KPI for their performance. If you're looking to reward if they're collecting the debtors quicker, that's a great one. Warehouse managers, you can reward them on stock turnover. So there is that kind of thing. So yeah, and my email address is there. Otherwise, you've got the webinar invitation. You're also more than welcome to pop an email through after the fact. And I'll be picking up the emails from the info@outsider.nz email box as well. So that is our webinar for today. And if anybody's got any questions as well, even next week, if you're not sure, only too happy to help. After the webinar, we will be sending out a small questionnaire for those that attended, just to get your feedback, because this is the first one we've run in quite some time, and we will be looking to run them again. Or even if you're interested in our new cash flow improvement program, pop through an email to either myself or to info@outsider.nz. We'd love to have you along. So that looks like that's about it. So that's done and dusted in half an hour. Thank you so much, everyone that came along. Oh, I've got one more question coming up. Hopefully it's a question. No, thank you guys so much for coming along. Really appreciate you taking time out of your day to sit through this webinar. Apologies if I do talk too fast. That is that's just the way I am. And I'll look forward to, hopefully in the next 3 months, we'll have one about some using technology in your business. So thanks everybody for coming along. Enjoy the rest of your day, and I'll pop you an email when this is on YouTube. So thanks for making the time. I know time is valuable, and I'll send out a brief survey later in the week. Enjoy the rest of your day. Stay warm. Bye-bye.